Welcome to GTM Navigator by Capital, our ongoing series where we break down the essential components of nailing the right go-to-market strategy. I'm Stephanie Perez, Managing Director of Business Development and Partnerships at Capital. Today, we're diving into all things proof of concept with longtime product and strategy executive Paolo Vincenti. We hope you enjoy the conversation as much as we did. Paolo, thanks so much for joining us today. We're super excited to have you on. As venture investors, we often get the perspective of the startup selling into the larger enterprises, but we seldom actually get the perspective of the buyer or the partner, right? Why you decide to partner with an external vendor, how those deals get done, and then how you think about and measure success for those type of vendor relationships and partners. And so with that, super excited to get started, but would love to just hear a little bit more about your background. So feel free to introduce yourself for the audience.
Thank you, Stephanie. I appreciate it, and very welcome to be here. I've been on both sides, actually. So I've been at the fintech and startup trying to sell, into large enterprises, and I've been the buyer of those services as well. And you're right, they're two very different conversations. So happy to explore this topic because I also think it's a very important one. The first half of my career was in consulting, but I actually started at a startup that led to a consulting life. In between consulting life and large enterprise work, I did a digital health startup as well. So the same questions were being posed and answered. And then I led both technology and product organizations in quite large retail and commercial financial institutions, where we did lots of work with startup and particularly fintech community offerings, trying to web them into our infrastructure. So very happy to be here with you and very happy to talk about this topic.
Wonderful. So I guess let's get started with the basics. What is a proof of concept? And when does someone decide to engage with another company through a proof of concept?
Sure. A proof of concept in my head is actually a misnomer, right? Because you're really not proving the concept. A proof of concept is a light engagement whereby a fintech or a startup can get a foothold working with a larger entity, and where a larger entity can do a contract light or engagement light version of understanding what the service or benefit would be. I think of a proof of concept as the experimentation box for the business case, right? It's the lab portion of learning how to work together.
And we hear this a lot, and it's often used interchangeably. But what's a proof of value, and how is that different from a proof of concept?
Sure, fair enough. I think neither of them describe what's actually happening, but if you think in kind of the classic way that we use it, the proof of concept gives you the data to build the proof of value. And I think ultimately what a lot of startups do wrong is they seek a proof of concept, aka my product is working in your environment, as the outcome. And it's in fact not even the proof of concept or the proof of value that you really want. You want the business case that will ultimately get the support within the larger financial institution to move forward to a growing commercial relationship. Because in the end of the day, everything hinges on that business case and its strength relative to the other business cases being considered at the time.
100%. Couldn't agree with that more. We always advocate for building a business case for the buyer so that they can make the argument internally, even earlier on in the conversation, right? Just to make sure that you're prioritized amongst, many other discussions and priorities going on. The next question is really about kind of a step-by-step guide. How do proof of concepts get done? I think large organizations can be a myriad of different stakeholders, different committees, and it's hard to know where to even start. And so can you give us kind of a walkthrough?
Sure, happy to. I think the single most important person in a proof of concept process is the sponsor in the legacy or large financial institution side, right? It's a person usually in a marketing, technology, or product role who says, hey, I have an unmet need, and there's this widget or this company out there that can meet this need, right? I need to demonstrate to the broader organization that there's value from engaging an outside provider versus building it internally or contracting it, frankly, from another provider, right? I think so. The first step is an introductory conversation between the technology startup and this larger entity where we talk about hey, the best way for you to understand our value is to choose an example or a small case. And this is, I guess, the kind of first piece of advice that I would give is that connectivity for connectivity's sake doesn't mean much. Two companies can get connected, data can flow and whatnot, but a proof of concept should focus on a value, an outcome, or a test to be completed. So the first step is a conversation around what that test is and identifying it correctly, and have kind of both parties say, yes, this would be valuable for us as a way to effectively demonstrate our services. And the larger institution says, okay, yes, it would be value to us because this addresses a need that we have. And then, the second step is some project planning and understand the scope, the time, the cost, the needs on both sides. The third step would be that the internal sponsor has to now go sell this to some subset of the organization that needs to kind of sign off for it to happen. Inevitably, you need technology resources, you need some data, you need someone on the commercial side of the business to be aware this is happening. And generally, you actually need like a third party or a customer or an internal party that's going to be the receiver of this service, right? That can kind of vouch for it. And then, you're back to planning, right? So then, okay, if everyone agrees this is a value, we're going to do this, it'll take 8 weeks, we expect this outcome. There's still the question of like when, right? If it's the day before Christmas, it's not happening tomorrow. You think about what's the appropriate day in the business cycle or period in the business cycle where you have the best chances of success. And usually I feel like those are the steps, at least to begin.
That's a great point. I just want to dig into that last point that you made, which is the buyer business cycle. Just because folks have big budgets, they get allocated very early. And so generally, come from the perspective of a bank, which you've worked at recently, what does that look like?
It's extremely structured, right? So it's usually tied to a fiscal calendar. So for example, we think of our year starting in January and ending in December, right? But the vast majority of planning for what is going to be spent and how it's going to be prioritized takes place at the end of summer of the previous year. So at the end of summer of the previous year, all the different departments are said, hey, what do you need for next year? What's the budget and how do you expect to spend it? Those are all rolled up into a process in September. That's sort of the laundry list of asks, which, big surprise, always far outstrips the amount of money that they're going to spend. And then a prioritization process happens where each kind of department's value, questions, feedback, requests are vetted against each other and sort of stack ranked. And they come out with a priority that says, all right, we have 100 million to spend. These are the major buckets that will allocate it. And then even within those buckets, we want to know, like, what is your top priority 1, 2, 3, 4, 5? For the very simple reason that senior leadership wants to say, I want to compare number 5 in the marketing organization against number 5 in the technology organization, against number 5 in the sales organization, and perform some relative value analysis on which one will create the greatest benefit organization-wide and make tough trade-offs. Those budgets tend to be relatively set by the 1st of October, and they tend to think of them as funding projects that either last a quarter, half a year, the entire year, or even parts of multiple year projects of the next year. For a large institution, they typically fall into 4 buckets. And I've never found a large institution that didn't have the same 4. There's always some bottom bucket of regulatory mandated, keep the lights on things that we have to do for safety and soundness. There's a second bucket that is usually platform maintenance, longer term investments, sort of critical infrastructure upgrades, tech debt, end of life platforms, migrations. Oftentimes those actually extend past the business unit that's even doing the prioritizing. So sometimes they kind of come down from a larger corporate group, like you're all moving to Salesforce, right? Even if a decision wasn't made in that business unit. The third bucket is multi-year strategic initiatives that like maybe in even leg 2 or leg 3, and they may be tweaking it, right? But if you say we're going to redo our entire front end for a large bank, that's not a 12-month process, right? Or you want to replace a core processor or a platform. That's a multi-year journey. So you may very well may be funding year 2 of the strategic build out and then still making some decisions on what direction. And the fourth will be discretionary, right? And discretionary are largely in business that are either revenue producing or cost optimizing or strategic new market entry, or some combination of all of those. In these investment stressed times, and financial institutions of all size are facing investment headwinds, not much is getting prioritized that is truly blue skies, try something we've never tried before, like just throw a 3-pointer and see if we hit it. Those 4 buckets are eating up all the investment available, and even within them, there is stuff that's being deprioritized and descoped in order to make sure that the business can both meet existing customer needs and do what it's got to do in a regulated environment.
Yeah, that totally makes sense. It aligns with what we're seeing in the market as well. I want you to put your startup hat on now.
Hmm?
Do you charge for POCs? And if so, how do you choose how to price your proof of concept, right? Depending on whether you have a business that's kind of SaaS, subscription based, or take rate, how do you decide exactly what that type of threshold will be based on whatever time bound engagement it is that you structure?
Sure. Very fair. My counsel would be charge for your POC because you're providing value and you want to start the relationship on the we have value here, but don't attempt to make money, right? Like, this is not the time to make money. The risk from your POC succeeding is even technical acceptance isn't top of the list, right? It's getting the business case and getting through all of the commercials, which will come later. So I would say charge something not that reflects the value of your solution, because that should come later. What you should charge is the cost you will bear as an organization, or some relative version of the cost you will bear to actually do the implementation on your side, because it will still take time and resources on your side. And that tends to be in the tens to low hundreds and thousands of dollars, shouldn't be more. You by no means want to be a financial burden. You also have to be mindful of the financial institution that above certain price points, you start to trigger these approval ladders within whatever Byzantine system they have. And if it's above 100 grand, then you need a head of a business. And if it's above 500 grand, then you need the COO of a business. And if it's above $1 million, then you need some group level person. And that just adds time and cost, because they have to go into some silly antiquated system and press some button and write some notes that they don't want to do, or there's someone forgot about. And I've seen those things hold up POCs for months. So I would even say come in with a very reasonable assessment of charge that reflects some coverage of your operating costs. And if it comes a sticking point, drop it or add it to a later contract, because it's not the hill you want to die on when trying to get a POC across the line.
Couldn't agree more. And thank you so much for providing a bit of detail on what those kind of approval thresholds look like. Because I think there's always the question of, whose approval do you need based on whatever pricing it is that you're setting. One thing that we see quite a lot, and this happens a lot, I think, when you are selling against an incumbent, and it's more about feature parity. But a lot of folks do a lot of feature build during proof of concept. And as you can imagine, that makes it extremely difficult for that company to scale, and also causes some issue in terms of what their product roadmap and deliverable dates look like for other clients. And so curious what your take is on that.
Yeah. I would recommend in as strong words as possible not to be doing feature build in a POC. In fact, I'm technically not sure why it is you're doing feature build at all in a POC, because you should have the features built, and the POC is to make sure they're delivering value within the target organization. Meaning, if you're dead set on entering a business or offering a capability, go have the exploratory conversation with their BD and product folks, understand what the need is, go away and build that. And don't even come starting a POC until it's built from your side, because I guarantee that there's going to be legacy infrastructure on the other side and some, just kind of testing and headwinds issues you're going to have to get over. You want your organization fully focused on making sure it's successful from the partner side at the beginning, and not debugging your own issues and whatnot. That just creates more noise, and it's quite difficult to get in the door with the POC. It's quite difficult to land one. It's quite difficult to convert that to a contract. Doing build on your side is like homework. It should be done long before you show up.
Totally, 100%. Couldn't agree more with that. So POC is done. You're right. You're having a conversation around what metrics you've hit. What do those look like generally? Like, how are you defining success of a proof of concept? Are those deliverables explicitly mentioned in an
Yeah,
SOW? How do you think about that? And then how do you communicate that to the partner and then also your senior stakeholders?
absolutely. Look, good practice is that that conversation is not happening at the end of the POC. It's happening in the beginning, and you got to define exactly what are we trying to do here. I would always counsel that technical connectivity is just the bridge, but it's no traffic. So a POC that says, let's get our two systems talking, let's get our APIs engaging. That's not a POC. You want to define a business outcome, and if it's like generate 100 new accounts, or deliver 1,000 marketing messages, or intake a data set, clean it and return this outcome, right? Or perform this analysis and show this output. Have it be measurable. Agree to what you're measuring up front. And then the end of the POC should be, all right, all the data has been gathered, all the traffic is driven across the bridge, such that now we can sit back and do analysis on, did the experience meet the business objectives, right? And then how do you measure that? Because the first part of the POC really is to complete it. And the second part is then now to, as we talked about, construct that business case for a future commercial relationship.
Definitely. And if you're a startup that's never sold to a large regulated financial institution, what are the types of committees that you should expect to have to go through once you're ready to actually go into commercialization and contracting?
Yeah, D, all of the above. So most large financial institutions have been forced by their regulator to institute a very rigorous process to the introduction of any products. And so the big ones are: one, are you touching my data? Two, are any customers affected by this? And three, is there any way this can affect the safety and soundness of your existing infrastructure? Meaning, even if you're not customer facing, and even if you're not messing around with regulated data, right? If the introduction of your feature set or our commercial relationship causes some downstream impact down the line to some other system going down or an incompatibility, that's a major issue, and banks have very, very strict governance around the regulation of that. So internally, the ones you'll never get around obviously are going to be like technology, data governance, procurement, right? They're going to be the front door. Behind that, you can easily expect legal, risk, compliance, audit, sometimes even internal audit, auditing the audit. Most will have sort of enterprise level CTO or architect functions that will say, okay, how does this play to our over architecture roadmap? And then any department or any risk. So I mean, like there's like risk, which is generally like commercial risk. There's also like ops risk, which is operational risk. The tech risk will have its own tech group, right, which reported into me once, which was like, is there any risk to our existing platforms from introducing this relationship? And they all will have the obligation to review what's being proposed, review the commercial arrangements, review the flow of data, and sign off saying, I've reviewed it and I'm comfortable with it. For the very reason that things go wrong, right? And when things go wrong, regulators look for throats to choke, right? So there's going to be, in addition to that process, which tends to be, via meetings, there's going to be a tool or a system where someone goes in and says, XYZ startup is doing this process. This is the scope. I've understood and read it, and I'm fine with it. So some groups might say this doesn't really affect me. I've read it, but past that, I don't have any concerns. Others may. If you end up manipulating first party, which I'll call customer data, or if you're providing a service to a large financial institution that then in turn is actually externalizing your service to their customers, you will have yet another level of rigor, to the point where they may even feel in their regular connections with the regulated entities to actually share their plans and have the regulator kind of soft approve that they're doing it. This is quite common. You want to get ahead of any potential problems, and regulators appreciate not finding out about things after you've already done them. So you're looking at that environment, right? And at least for the bulge bracket banks, there isn't a single one that hasn't received what we call a control letter in the past decade, which is a letter saying, hey, you've overstepped and this is how you're going to fix it. So they are given a rating each 18 months based on their control environment. And if that rating ticks up, ticks up, it's fine, it's rare. Ticking down more than 2 steps will actually get a suspension of your ability sometimes to extend credit or operate in certain products. that is very serious, right? That's lights out for a financial institution. So they treat this topic very, very carefully, and plenty of POCs have died on the vine going through this approval process.
How do you suggest that folks perhaps multi-thread or run
Mhm.
different kind of work streams? One of the things that we've seen is perhaps having an SOW statement of work for a proof of concept potentially roll over into a larger master service agreement. What are different kind of ways that you would suggest that startups approach the contracting process in order to get involved with multiple different stakeholders across the organizations at the same time?
Very fair. It's another question that comes down to like whose paper, right? Your paper or their paper? It's always going to be their paper, so don't even bother. What I would say is because a large bank will be like, just no, and
It's
take it or
not
leave
even
it.
an option, yeah.
So what I would do is, make it easy for them. Go and say, hey, we're flexible, right? We're a startup. So send us your term sheet for a proof of concept, but at the very same time, send us your MSA for a larger relationship. And while we're working on the proof of concept, let's also start vetting what an MSA would look like after and kind of work through it. The challenge that most startups have is that MSA has language that protects large financial institutions from doing business with kind of unapproved or unstable companies, right? So they tend to ask them very onerous details. If you're a startup and you're like doing amazing and you're growing by leaps and bounds and you're 2 years old and they say we require 3 years of financial statements, what do
Yeah.
you do, right? If they say, well, okay, you have to at the very least show us, your entire site safety plan for where your servers are located, and you say, okay, well, we're small, like we outsource all of that to a third party, right? They say, okay, well, then the third party has to do it. The requirements of some of those contracts will be quite onerous. Doesn't mean you can't get past them, but it's a long and tedious step to get through. So given that you're not going to be able to move them off of using their paper anyway, or there'll have to be a risk acceptance process for whichever parts of it you can't apply with, which is normal, by the way. There's a misnomer that like if you can't comply with everything that's on that piece of paper, you can't do business. You can, and even very, very large suppliers, even suppliers at times larger than the financial institutions that they serve, still will have some provisions within the paper of the financial institution's contract that they can't abide by. And so there's a risk review and acceptance process to kind of give them a freebie. So that exists. Wouldn't count on it, but I would say be aware of that and be friendly and work with their legal team on the existing whatever they've used for POCs or MSAs before, because the least amount of edits to the contract will save you the most in legal fees and get you the best chance of a commercial arrangement.
Not to sidetrack, but this just came to mind, and it's less relevant to proof of concept and more so to the actual commercialization and commercial negotiation. As a large institution, how do you think about partnering with a startup that could be potentially acquired by a larger
Yep,
entity? There's a lot of consolidation in the fintech space, as you know, there's a
there
lot of
is.
M&A on the corporate side going on. And so curious how you think about that and any potential kind of risks that would entail.
Yeah. Um, Look, it's certainly a risk, right? When you work with a smaller company, they get acquired. An even larger risk, I would say, is that they don't, but that at some point in their evolution, they start to re-platform, and the same service gets delivered in a different way. We consider that a whole new need to kind of re-qualify, right? And there's some risk in there too. You can write provisos into the commercial agreement to protect for that. Ultimately, if the acquisition doesn't affect the service that you receive, then that's fine, and we've seen that happen. It's a chicken and the egg, because oftentimes if a startup can get enough financial institutions on board, they then now become attractive to the legacy players that want to either take them out of the market or reverse acquire those customers through acquiring them. And that's their value prop, right? You want to do that. So that I think that's less of an issue. At times, what some more savvy startups have done is actually engage the commercial leadership of the bank as board members or as advisors, and then they sort of have a seat in that decision-making process. It's not a terrible thing when a small company gets acquired by a larger one, especially from an infrastructure and safety and soundness perspective. Like there is a safe pair of hands approach. So yeah, the risk is more to the commercial side, I think, than the delivery.
Yeah. No, completely. So here's my last question. And you've been doing this for a long time, and you've done it at different types of companies, and you've been on both sides of the spectrum, or the table, I suppose. What are some of the biggest mistakes that you've seen companies make?
There's a lot of them. I'll think of a few that come to mind that are most prevalent. I think the first and my favorite is understand that the time in your project plan to implement something is not the time in a target financial institution's plan to implement something. And every single startup that it came to pitch me in my various roles would always say something great, like, oh, it's just 2 weeks of no code, or oh, it's just a 6 week long effort to partner with us and you're up and running. I'm like, it's a 6 week long effort to plan a meeting with the stakeholder to sign off on this thing on our side. So it's 6 weeks for you. It's not 6 weeks for the target entity, right? And you got to be realistic and understand that even if the coding on their side is 2 days worth, right? They may only be testing it, every month or every other month, and then you may be full for a couple slots. So your wonderful POC may be, sitting like an airplane at 6 p.m. at JFK, waiting in a line of 90 other planes to take off, and that's business, right? So understand the target player that you're working with, and ask the questions of their team, like how long will your part of this take, even if you think it's quite minimal. Same goes for testing, right? Count on testing. It's not you testing your part, it's them testing their part, and then it's you testing those parts together, right? In orchestration as two entities that both have to do that. I found this is something that startups are particularly bad at. They say, oh, well, our offshore team tests in these hours. And then the financial institution says, okay, well, our onshore team tests at a completely different one. So how do we work together? Or sometimes the opposite, right? Sometimes, the startup is onshore and their engineers are local. And the offshore testing of the larger financial institution is 12 hours by time zone away. They've got to be able to work together at the same time, and you got to anticipate that flexibility. Other mistakes: define clear outcomes up front, and that's commercial outcomes, right? So what would irrespective of what you're trying to do, there is a business decision to be made at the end, and POCs convert into master services agreements and long relationships when a business case is made, right? So thinking upfront about not technical connectivity, not our product, by no means like the marketing buzz. Like I remember one fintech startup that wanted to come work with us, and their priority on the contract was like, what date can we announce that we're working together? And I was like, isn't a successful engagement more important than announcing what date we're working together? And their answer was no, frankly. That always surprised myself and the executive team, right? Focus on what's most important, which is getting everyone to agree on the right commercial outcome for the POC, and then nailing that, because that's the foundation of your business case. Otherwise, you have the opposite. You have a POC, you put in a bunch of time and effort, it failed, right? Or it didn't go forward. But then the organization remembers, oh, we did something with those guys, and it didn't really, what reason do I have to reopen that door again? You get one shot at most of these. Yeah. You want to make that shot count. Absolutely. And then I think the last one, which I think we touched on a little earlier, is be realistic about your start date. Understand the cadence and the plan and the timing of the larger financial institution. If they're heavily engaged with retail players and you're dead set on launching in Q4, it's not going to happen, because that's like they shut down most development and they're focused on operational stability in that time. There's good and bad times of the year and of a commercial cycle when to plan it. And again, given that you have that one shot, ask the champion that you're working with in the legacy institution, hey, is it worth delaying this a quarter in order to achieve the best outcome? I think startups and fintechs don't think that way. They think, well, I've got X weeks of burn and I got to work backwards from that. It's absolutely worth waiting a quarter if it gets you the outcome that you need, right? Because there's only X number of large players and you're going to get Y number of chances with them. You got to make them count.
Well, thank you so much for joining us, Paolo. I really appreciate it. That was a super insightful conversation. So thank you so much for the time.
Great, Stephanie. Thank you for having me on.